If you own your home and you're over the age of 62, there is a very good chance that right now, today, you are overpaying on your property taxes. Not by a little, in some cases by hundreds, even thousands of dollars every single year. And the reason isn't complicated. It isn't fraud. It isn't some government error. The reason is simply this. Nobody told you the benefit existed, and the system isn't designed to remind you. That's what we're going to talk about today. Because this isn't just about one tax exemption. This is part of a much larger pattern affecting millions of American retirees. A pattern where benefits go unclaimed, rules quietly change, and seniors end up with less money in their pocket simply because the information never reached them in time. So stay with me, because by the end of this video, you are going to understand something that most retirees in this country never figure out, and once you know it, you can act on it. Let's start with a number that stopped a lot of people in their tracks when it first came out. According to research compiled from state tax agency data and senior advocacy organizations, roughly 87% of homeowners over the age of 65 who qualify for some form of property tax relief never apply for it. 87%. That means if you gathered 10 seniors in a room who all owned their homes and all met the income or age requirements for a property tax exemption, only about 1 or 2 of them would actually be receiving that benefit. Now, here's what you need to know about why that number is so high. It's not because people don't want the money. Of course they do. It's because in most states, property tax exemptions for seniors are not automatic. They require you to apply, and not just once. In many states, you have to reapply every single year. And if you miss the deadline, you lose that year entirely. No refund, no catch-up. Gone. Let me explain this in simple terms. When you turn a certain age, and this varies by state, but it's often 62, 65, or sometimes 70, many local governments give you the right to reduce the taxable value of your home. Some states freeze your property taxes entirely at their current level so they can never go up no matter what the market does. Others give you a flat dollar reduction, say $25,000 off your home's assessed value. And others calculate your benefit based on your income, which means the less you earn in retirement, the more relief you qualify for. But here's where many people get caught off guard. These programs don't have names that make them easy to search for. They're called things like homestead exemption, senior freeze, circuit breaker credit, over 65 valuation limitation, or disabled veteran property tax relief. The terminology changes from county to county, state to state, and if you don't know what to search for, you won't find it. Here's the important part. This is not a small benefit. In Texas, for example, seniors 65 and older can qualify for an additional homestead exemption of $10,000 on top of the standard exemption, plus a school tax freeze that locks in their school district taxes permanently. In Illinois, the senior freeze exemption can reduce a qualifying homeowner's assessed value by tens of thousands of dollars. In California, Proposition 19 allows seniors over 55 to transfer their property tax base to a new home anywhere in the state, meaning if you've lived in your home for 30 years and you want to downsize or move closer to family, you don't have to give up those low property taxes you've built up over decades. Now, you might be thinking, well, I've owned my home for years. Surely my county would have told me about this by now. And this is something most retirees don't realize. Counties and municipalities have no legal obligation to notify you that you qualify for an exemption. They will happily collect your full tax bill every year, year after year, and never say a word. In fact, from the local government's perspective, every unclaimed exemption is revenue they get to keep. This brings us to the broader picture, because property taxes are just one piece of a much larger puzzle that affects your financial security in retirement. And right now, in 2026, there are several changes happening at the federal and state level that every senior needs to understand. Let's talk about Social Security, because this is where things get very real for a lot of people. If you are currently receiving Social Security retirement benefits, or if you're planning to claim within the next few years, there is something happening right now that deserves your full attention. For decades, there were 2 provisions in federal law called the Windfall Elimination Provision and the Government Pension Offset. These rules reduced or completely eliminated Social Security benefits for millions of Americans who had worked in certain government jobs. Teachers, firefighters, police officers, state and federal employees, jobs where they paid into a pension instead of Social Security. For years, retirees affected by these rules fought back. They argued that they had worked other jobs in their lifetime, paid Social Security taxes faithfully, and still had their benefits cut simply because of their government service. Late in 2024, Congress finally passed the Social Security Fairness Act, which repealed both of these provisions. The president signed it into law in January 2025. And now, in 2026, the Social Security Administration is still in the process of implementing those changes and issuing back payments to affected retirees. Now, here's what you need to know if this might apply to you. The Social Security Administration is processing these recalculations in batches. If you were previously affected by the WEP or GPO, that's the windfall elimination provision or the government pension offset, you should have already received communication from the SSA. But not everyone has. If you worked in a government job at any point during your career and your Social Security benefit seemed lower than you expected, it is worth calling the SSA directly at 1-800-772-1213 or visiting SSA.gov to check whether you qualify for a recalculated benefit or a back payment. And this is something most retirees don't realize. The back payments for some individuals could be substantial. We're talking about monthly benefit increases that, when calculated retroactively, amount to thousands of dollars for some retirees. The SSA has said these payments are being processed automatically for most people, but if you have not seen a change in your deposit amount and you believe you should have, you need to follow up. Don't wait for them to come to you. But this is where it gets serious, because with any large government payment or benefit increase, there is always a corresponding rise in scam activity, and the targeting of seniors around Social Security updates is aggressive and sophisticated right now. Here's exactly what is happening. Fraudsters are calling seniors, sometimes with your real name, your real address, sometimes even spoofing the actual Social Security Administration phone number on your caller ID. They're telling people that in order to receive their back payment or their increased benefit, they need to verify their Social Security number, their bank account information, or pay a processing fee. Some are even telling seniors that their account has been flagged for suspicious activity and that they need to act immediately to protect their payments. Let me be absolutely clear about this. The Social Security Administration will never call you and ask for your Social Security number over the phone. They already have it. They will never ask you to pay a fee to receive a benefit. They will never tell you that your account will be suspended unless you wire money, buy gift cards, or send cryptocurrency. If anyone calls you saying any of these things, hang up immediately, then call the SSA directly using the number on their official website. Now let's talk about something that affects nearly every senior who has savings, investments, or even just a regular checking account: the IRS and its reporting requirements. There has been a lot of confusion in recent years about bank reporting rules, specifically whether banks are required to report your transactions to the IRS. Here is the accurate, straightforward explanation. Under current law, banks are required to file what's called a currency transaction report for any cash deposit or withdrawal over $10,000 in a single transaction. That has been the rule for many years, and it hasn't changed. What some seniors may have heard about is a proposal that was considered a few years ago that would have required banks to report all accounts with over $600 in annual transactions. That proposal was rejected and did not become law. So if someone told you that the IRS is now monitoring every transaction over $600 in your bank account, that is not accurate under current law. However, here's what is true and what you should understand. The IRS does use various data matching programs to verify that the income you report on your tax return matches information reported by your bank, your brokerage, and your Social Security Administration. If those numbers don't match up, it can trigger a notice, not necessarily an audit, but a letter asking you to explain the discrepancy. And for seniors who may have multiple income sources, Social Security, a pension, a small part-time income, withdrawals from a retirement account, these mismatches can happen more easily than you'd think. Here's the important part. Social Security benefits may be partially taxable depending on your total income. This surprises a lot of retirees who assumed their benefits were always tax-free. The rule works like this. The IRS looks at something called your combined income, which is your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits. If that number is between $25,000 and $34,000 for an individual filer, up to 50% of your benefits may be taxable. If it exceeds $34,000, up to 85% of your benefits may be taxable. For married couples filing jointly, Those thresholds are $32,000 and $44,000. Now here's where it gets serious for many retirees. Those income thresholds were set in 1983 and 1993. They have never been adjusted for inflation. So every year, as Social Security benefits increase through cost of living adjustments, more and more retirees cross those thresholds without earning any more real income. What this means in practice is that your COLA raise, the increase you receive to keep up with the cost of living, can actually push more of your benefits into taxable territory. You end up with a bigger gross number, a bigger tax bill, and in some cases, a smaller net check than before the raise. This is something most retirees don't realize until they file their taxes and get an unexpected bill. If this is a situation you're in, or you think you might be, the most important thing you can do is talk to a tax professional or use the IRS's own withholding estimator tool, which you can find at irs.gov. You can also ask the Social Security Administration to withhold federal taxes directly from your monthly payment, which can help you avoid a surprise bill in April. Let's go back to the property tax benefit because there is something else here that ties directly into everything we've been discussing, and it has to do with the financial pressure that's building for seniors right now. In 2025 and into 2026, home values in many parts of the country remain elevated compared to historical levels. That is good news if you're thinking about selling, but it has a significant downside for homeowners who want to stay in their homes. When your home's assessed value goes up, your property tax bill goes up. And for seniors living on a fixed income, primarily Social Security and perhaps a small pension or modest savings, a rising tax bill isn't something you can just absorb. It's money that has to come out of your grocery budget, your medication budget, your utility payments. This is exactly the kind of pressure that property tax exemptions were designed to relieve. And this is exactly why claiming every benefit you're entitled to is not a nice to have. It's a financial necessity. So let's make this practical. Here's what you should do in the next few days. First, contact your county assessor's office. You can usually find this with a simple internet search for your county name plus property tax exemption for seniors. Ask them directly. What exemptions exist for homeowners over 65 in my county? What are the income limits and what is the application deadline? Write that deadline down. Treat it like a bill due date. Second, if you worked at any point in a government job, local, state, or federal, and you receive Social Security, visit ssa.gov or call the SSA to ask whether the repeal of the windfall elimination provision or the government pension offset affects your benefit. Even if you think it doesn't apply to you, it costs nothing to ask. Third, look at your most recent Social Security statement. You can access this online at ssa.gov by creating or logging into a My Social Security account. Review your earnings history to make sure it's accurate. Errors in your earnings record directly affect the size of your benefit. If you see a year where you know you worked but no earnings are listed, that needs to be corrected. Fourth, consider whether you need tax withholding from your Social Security benefits. If your combined income is above the thresholds we discussed, having taxes withheld each month can prevent a large unexpected tax bill. You can request this by filing IRS Form W4V. And fifth, this one is simple but important. Make sure the people you trust know about these benefits too. Your children, your siblings, your friends at church or at the senior center. Most of the 87% who never claim these benefits don't know they exist. That number doesn't have to stay at 87%. Here's the thing that ties all of this together. The financial system that affects seniors in America is complicated by design. The benefits exist. They're real, they're legal, they're yours to claim. But they are buried in county websites, government portals, and federal forms that were not written with you in mind. The people who figure out the system aren't smarter. They just had access to the right information at the right time. That's what today was about. Not creating panic, not alarm, just clear, honest information that you can actually use. Because every dollar you're entitled to, whether it's a property tax reduction, a corrected Social Security payment, or a properly managed tax withholding, is a dollar that stays in your life, in your home, in your retirement. You spent decades working for that money. You paid into these systems. You earned these benefits. The only thing standing between you and what's rightfully yours is knowing they exist and taking the 1 or 2 steps required to claim them. So do that, this week if possible. Not because there's a crisis, but because you've already waited long enough. If this video helped you understand something you didn't know before, Share it with someone who might need it. Subscribe so you don't miss future updates. And leave a comment below if you have a question about anything we covered today, because if you're wondering, someone else is too. Take care of yourself, and we'll see you next time.